Hey traders, just before we get started, real quick, a shout out to Quant Strats. This is the premier quantitative trading conference in Europe this year. It's in London. If you're in London, October 2025, on the 14th and 15th of October, and particularly if you're in industry, if you work for a quant firm or a quant fund, you're going to love this. There's going to be over 600 quants, PMs, data scientists, academics, regulators, all there exploring the full spectrum of all things quantitative trading. 2 full days, interactive, thought-provoking sessions, expert masterclasses, deep diving, cutting-edge modeling techniques, the intersection of AI and quant, and the innovations driving alpha in today's markets. This is a must-attend event if you are in the industry and you want 10% off. The coupon code is ALGOADVANTAGE10. We're super happy to be working with Quant Strats this year. Now on with the show.
I do design things that are basically robust enough to contribute across all markets. And what you'll find is a standard deviation of closing streaks across all markets. And one standard deviation is 2.4 days.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
So I was pleasantly surprised in my conversation with Brent Penfold. You look at his website, he's been around for 40 plus years. He's got a website out of the 80s. And he does admit he's a bit of a caveman when it comes to trading sometimes. But of course, I got on the phone with him and realised, Brent, that you're still doing very well. And I believe you had a very good year in the financial year we just finished. So welcome to the show. And how was your year that we just finished up?
Well, first of all, Simon, thank you for having me. And I had a good year last year. I made 29%, and that's my sweet spot.
Awesome. Yeah, wonderful. And Brent, just to dive straight into it, tell me about your hierarchy of needs in trading.
Oh, for sure. For me personally, what I've learned over the years, there's 5 important needs I need to satisfy. So my hierarchy of needs refer to, first of all, in trading, my number one priority is not to make money, it's just to survive. Dead set, it's to survive. And if you talk to a lot of experienced traders, what they will reveal to you is that their success isn't so much their entries and exits, it's their risk management. They're basically risk managers. So my first one is survival, and my big thing is risk of ruin. I want to make sure that the strategy I'm trading with the money management plan I want to attach to it produces a statistical risk of ruin of 0%. So straight up survival. Does this strategy have enough edge? Am I sensible enough with my money management that when I combine them, I've got a 0% risk of ruin? So first of all, survival, right? That's our number one objective. Secondly, pain. I have to understand or know what my potential pain will be in the future. So I always look at the worst historical drawdown, knowing that the future worst historical drawdown is going to be worse than what we've seen historically. So you need to have your eyes wide open to say, terrible things happen, and you hope that your equity curve will remain stable. But there's every likelihood you'll have a dip, and are you comfortable with that pain? Well, you probably won't be comfortable with the pain, but can you survive the pain? So survival, pain. And then I want to know, what's my reward for my risk? I want to look at a risk-adjusted reward. I don't use a Sharp radio. That's a legacy tool. That's for fund managers who basically don't want to scare the horses. They don't want to lose their customers. So they love the Sharp ratio because it uses the standard deviation as the default risk measure, which penalizes upside returns. Sharp ratio penalizes upside returns. So I look at my also performance index that takes into account historical drawdowns. So I want to maximize my 1 unit of return per 1 unit of average drawdown. So the strategy that gives me the most amount of 1 unit of return per 1 unit of historical drawdown, that gives me my risk-adjusted reward. So I want to know what reward will I have for the pain I'm going to suffer. If I jump over that screen, my next hierarchy of needs is the strategy has to be tradable. It's no good having a strategy that's made $1 million, but along the way there, you sort of make 100 and you're down to 20, and you're up to 120, you're down to 20, and and suddenly up to 300, and you're down to 100, and you might end up at a million, which looks wonderful, but it's not tradable. So I always look at the R squared, which is just a regression analysis. Just look at the smoothness of the
equity curve. Yeah.
Yeah, so we just want to know, is this tradable? And then finally, how efficient is the strategy at making money? So my final thing I look at is the compound annual growth rate, because no strategy, no system developer, no sneaky little devices can hide from the compound annual growth rate. Anyone can produce a wonderful historical equity curve. There's like a 45-degree line, just looks picture perfect, right? But what you'll find is their secret sauce behind their special strategy is that they use enormous stops. They basically avoid stopping out.
Yeah.
And we know that money management or position sizing is a function of what you're risking. And strategies with large stops implies you can only have very, very small position sizes. So you're never going to make a lot of money. It won't be efficient at making money. So they're my hierarchy of needs. I want to be able to survive. What's the risk of ruin? That's the first thing I look at. You got to calculate it. If you don't know what risk of ruin is, probably best just pause your trading and just read some stuff and understand it. So I believe that's the anchor. That's the anchor of what I do is trading with a 0% risk of ruin, because I can suffer 50 losing trades in a row and I know I'll still be around.
So tell us how you do calculate risk of ruin, because I got to say, when I first heard it, I thought, well, that's impossible because someone will find a way of ruining themselves. So what is the actual calculation, and what do you mean of bringing your risk of ruin down to zero?
Yeah, essentially it takes the two key inputs into what we trade, which is basically how do we trade. So we need to know what our expectancy is. And expectancy is just a calculation of combining, how often do you win, and what's your average win-to-loss ratio, less how often do you lose. And that expectancy tells you how much can you expect to earn for every dollar you risk. So that's basically it's your edge. So we need to define our edge. That's one half of the equation. The other half is how much are we risking per trade? Are we risking a lot or are we risking a little? And when you combine those two, it produces a mathematical statistical thing called risk of ruin, that if you continue to trade the way that you've just outlined, it'll tell you, your chances of going bust. For example, if somebody has a $10,000 account and is really confident and wants to risk $2,000 per trade, they have 5 units of money. So if they lose 5 times, they lose 2,000, they lose another 2,000, that's 4,000, they lose another 2,000, that's 6,000. So they've only got 5 trades of losing $2,000 each before they wipe their $10,000 account out, right? And then that's their money management approach. And then you look at their edge. And the edge, whatever it is, could be like 20% or maybe 30% expectancy. Well, I can tell you, if you've got 5 units of money and a strategy producing 30% expectancy, your risk of ruin will be probably be above 40%. And it's guaranteed you go broke. It's just a matter of time. Some people may have risk of ruins of 1% or 2%, and they'll think, well, that's quite good. It's better than 40%, better than 30%. But even 1% is too high. You're still guaranteed to go bust. It's just that you'll take longer to go bust.
Yeah.
So we need to get that down to zero. And if people can basically tattoo 0% risk of ruin on their eyelids, so they're aware of it all the time, people will be far more sensible about their trading, because people aren't stupid. Once they have the knowledge, they're going to go, oh, wow, didn't realize it, but my risk of ruin was 12%, and that's probably better than some other people, but it's still suggesting that there's going to be, signposts along the road that are saying you are approaching your ruin. You're just 10 kilometers out, and suddenly you're 5 kilometers out, and you're 1 kilometers out, and you're almost about to reach your ruin point.
Yeah, you said to me the other day that people are emotionally disorientated. So, yeah, what did you mean by that?
It's I'm not sure about you, but I know about me. I came into trading to basically not to lose and make a lot of money. And if I could have made it yesterday, it's preferable to making it today.
Yeah.
And so what I talk about is only with experience, and I've blown up 2 accounts. I've almost blown up a 3rd account. That you just nut these things out. And what it means is that most people come to trading because of greed, and there's nothing wrong with that. Hey, in our past lives when we've had normal jobs, we've always gone for the best wage. So it's in our DNA. We just want to get ahead, right? So it's not bad. So you come to trading and you want to basically, not lose any money, make a lot of money. So I refer to that as being emotionally disorientated, because accuracy is only one half of expectancy. The other half of your expectancy is what is the average win to average loss, right? So I think people have to understand about risk of ruin and go, it's real, and that doesn't prevent you from looking at ideas that interest you, but it provides guardrails to say, okay, if an idea resonates with you, go off and have a look at it and examine it and do your back testing. But understand that at the end of the day, you got to calculate what your risk of ruin is given the expectancy of the strategy and how many units of money you're going to apply with your money management. And so people come in to trading because these influencers showing you how easy it is to trade, how rich they are and how successful they are, and you want a piece of that, which is normal. So you're looking in the wrong direction. In my opinion, people have to change their emotion to basically, I think, say their objective in trading shouldn't be to be right. Their objective in trading is not to make $1 million overnight, but they should tell themselves that their objective in trading is not to be right or wrong, but to manage their risk capital with a modest expectation. And then picture themselves 12 months down the track as they review their previous 12 months and say, did you make your 20%, your 30%, your 40% with manageable risk? And know that when you look back, because you've followed a prescriptive process, because you probably, I hope, become a mechanical trader. So you just, basically joining the dots every day. You go, my God, this is so repeatable. It's so scalable. And sure, you're not making 50, 60, 70 or 100%. You're not going to win any competitions. But we'll all live to 100. And we'll have compounding on our side. And people should just think, what's that return that's going to satisfy them, that modest expectation. And I think that will help them just to come off that euphoria mountain, come off that pedestal of, praying to the rich people and come down to sort of more working class trading, which is sustainable. So my whole thing is about sustainable trading.
Yeah, I like that. Be a working class trader. It doesn't sell well on YouTube, Brent. See, that's the problem. So definitely you're supposed to be able to make 100% and if not per month, depending on who you're watching.
That's right. Yeah.
So let's jump back. I mean, you've been trading for 40 plus years. I believe you did start with discretionary trading. So how did you get into systematic trading? And let's start there.
Oh, sure. Well, I was lucky enough to get a job with Bank of America when I was at uni. I'd done my 3 years of my commerce degree, and I was doing a 4th year for honours. And I just wrote off to a whole bunch of merchant banks in Sydney asking for work experience. Anyway, Bank of America kindly offered me 3 months of work experience, and my first month was in the money markets. And that just imprinted me. It happened at a time in 1983 when there was speculation that the Australian dollar, which was fixed then, would be floated. So everyone was just pouring in, buying Aussie dollars. And of course, they want to park their money in short-term securities. And I was on the securities desk. And so as a 21-year-old, I saw our desk make $1 million, when $1 million was a lot of money back then. So that was what imprinted me. And then also I got lucky that was it Neville Rand?
Not sure.
Oh, the Paul Keating. He introduced foreign banking licenses.
Yeah.
So prior to 1983, we had just the main Australian banks,
Yeah.
and they opened it up to foreign banks. And Bank America had a merchant bank in Sydney, and they wanted to apply for a banking license. And so they basically expanded the dealing room, and they offered me a job. So I stayed. So I was very lucky. I stayed. And then, as a side note, I didn't do my honours, but I convinced our treasurer and I convinced our treasury accountant to join me, and we did our masters together part time over 2 or 3 years. So I did beef up my degree. Anyway, back in those days, discretionary, and I was introduced to Elliott Wave, and that was my roots. That was like a duckling. That's what I was imprinted with. So essentially, for the first from 83 to 95, what's that, 12 years, Elliott Wave. I couldn't, in my hands, apply it consistently enough to get a result. And as I mentioned earlier, I blew up twice. My broker had a partner and who'd never talked to me, but just passed me to my broker. And one day I was calling him up and, to get another, get a feel for another losing trade. And Jeff Morgan, who later became one of my mentors. And I've never spoken to Jeff because I've always done my own thing. Brokers are brokers. They're there for a service. They're not, I'm an ex-institutional dealer. I don't ask other people for opinions, right? So I never asked him for opinions. But I was just probably depressed, like another losing trade. I just said to Jeff, this SPY. Now, the SPY is our Australian share price index contract. It's the same as the E-mini S&P in the US, or the DAX, or the FTSE, the Nikkei, the Hang Seng. In Australia, we call it the share price index. I said to Jeff, where's this market going? And Jeff very calmly said, well, Brent, the SPY has just completed its median move of 3 higher closes. So I would expect there to be a pullback. So I'd be looking for places to sell. And I went, okay, thanks, Jeff. Well, next day, the SPY fell. And that was my light bulb moment.
Patterns.
That light bulb moment of just stats, just looking for evidence. And I thought, how good is that? And that basically was the beginning of my journey to becoming a mechanical pattern trader.
Yeah, nice. Once you get that was the same with me. Is once I even had the idea that I could properly statistically validate things, there was certainly no turning back.
Yeah, and it's just evidence-based. And we as mechanical traders, we're not looking for a strategy that's going to be guaranteed, to have an upward, rising equity curve without any mishaps, right? We're not foolish, but we should be able to, and we deserve to see evidence of what we'd like to do, has an edge.
Yeah, absolutely. Well, let's dive into your style a little bit. So, I mean, start from the top. Tell us just what you trade. Obviously, I know it's futures. Tell us what you trade, what markets, over what kind of time frames. What's your top level philosophy with your trading?
Well, I trade a portfolio of 30 markets. 24 of those markets are diversified over 8 sectors. And they include indices, currencies, interest rates, the energies, the metals, the softs, the grains, and the meats. So I trade a diversified portfolio. And what I trade is the 3 most liquid futures contracts in each sector. Because one of the big traps in trading is data mining. You only trade what historically has been the best markets, and so to help protect yourself from not falling into that trap of data mining, you really should be trading an arm's length, objective, independent portfolio. Now, my background is indices, and so I still trade the Asian and the European indices. So my what I call my P24 portfolio, which is the 3 most liquid futures contracts across 8 segments. I add on the Nikkei, the Hang Seng, the SPY, the Australian SPY, the FTSE, DAX and stock 50. So that's the portfolio I trade.
Mm-hmm.
I'm a mechanical trader. I basically trade a portfolio of strategies. We were speaking about this other day. I basically trade a portfolio of 20 models or 20 patterns. I'm basically a mechanical pattern trader. So I have 20 patterns I trade. I generally trade those patterns across the whole portfolio, although I do know individual markets have their little individual idiosyncrasies. And so with my indices, I don't trade all of my diversified stuff over the indices. I use some other things on indices. So that's my portfolio. It's, I believe, a diverse portfolio. And my models, the patterns I trade are a combination of trend following and mean reversion. Out of the 20 patterns I trade, 5 are straight out trend trading, the other 15 are mean reversion. But out of the 15 mean reversion strategies, over half of them are trading in the direction of the trend. So I'm using a mean reversion entry to try and catch a continuation of the trend, if that makes sense.
It does.
Yeah. And I trade over multiple time frames, immediate, short term, medium term. I've got one long term strategy.
And but everything you do is on daily bars or bigger. You don't do anything on hourly bars, do you? Or
No, not at all. I do everything on end of day bars. Everyone's life cycle of trading. It doesn't matter. People can come into trading on their own particular time frame, whatever that is. But everyone eventually attempts to do day trading because they think that by being square at the end of the day, if they're just trading 10-minute bars or 4-hour bars or whatever it is, that they're managing their risk because they're going home square. And that's just rubbish. You're not managing your risk. You're being more disciplined. You're taking your losses, but you don't know what your risk is. So most people are ignorant about what they're doing. I trade end-of-day bars, and I basically trade what we talk about is combined session bars. So today, compared to when I started back in the 80s, today, most markets operate 23 hours a day. Yeah, and so being in Sydney, Australia, is such a good time period because when I wake up, North America is closing. And North America is the last major market to close. And so I've got this window of a couple of hours where I wait for, I use Norgate to have the data available. And I basically just download the data and put my orders in for the next 23 hour cycle. And essentially, it's set and forget.
Yeah.
I basically do it right now with, I think the US is coming off daylight saving. I'm not sure what it is, but I'm finished. It usually takes me about an hour to do my stuff, and so
mornings. So
yeah.
all those 30 markets, do you manage to keep them all on the CME, or do you have to trade a couple of exchanges?
The P24s are all CME.
Yeah, okay, that's
and
handy.
I love that because the US is the largest market in the world. It's a truest market. There's less chance of manipulation. You look at the daily volume on the contracts you trade, like you look at the value of the 30-year bonds or the S&P 500, the daily value on the CME. It's billions and billions and billions worth of volume.
Yeah.
So you're not going to get.
So you're trading CME, 30 markets, just with the timing of trading daily strategies, because I believe that even on the CME with those, by the time you're trading softs and grains and currencies and so on, they would still have slightly different end of day times, or actually, I suppose, are they all the same? So do you have a clear end of day cutoff point? And I guess, part B. Okay, part B would be: do you have a do you try to get all your orders in that window, even if it's only 45 minutes while the markets are closed, or it's sort of not that problematic if you get orders in the overnight US session?
No, it's a good question. For what I trade, the last markets to close are basically CME, Chicago, 4 p.m. That's they close. They keep trading for about 45 minutes after the New York share market stops.
Yeah.
And so the futures keep trading for another 45 minutes. And I think it's 4 p.m. they stop. and they restart at 5 p.m. Now, I should know this stuff, you know.
Yeah.
All I know is you got 1 hour. You got 1 hour, and I usually get my orders in after the commencement of the next 23 hour bar, because I'm reliant on Norgate to have their data available. If markets are moving fast, I can sometimes miss the entry, and I just got to go to market because it's gone past my entry level, and I go to market. But it rarely happens. When the US, another good reason why trading the US is attractive is that everyone keys off the US. And so when the US has finished its day in the office, everyone just slows down. Does that make sense?
Yeah.
So it's actually a really sweet combination where we are in Australia. It's just a perfect window to for mechanical trading.
Well, it's perfect. Yeah, it's perfect for stocks too for me, because like the trading happens overnight. So I'm asleep while my trading takes place on the.
Well, there you go.
Stock market.
Isn't that nice? So you don't get distracted or worried.
That's right. You're not looking at it. You get 2 days for the price of one, which, talk about compounding, that's not a bad little bonus. So, all right. So let's talk about diversification then. You've got 30 markets, 20 models. Tell us a bit about how all that works together, because I understand you don't have 20 models running independently on 30 markets, and therefore having 600 return streams essentially, and then the possibility of taking multiple trades in a single market. So how do you manage that diversification?
That's a good question. Each of my models, each of my patterns attempt to capture a unique part of market structure. So I don't have 20 medium-term trend trading patterns that they're all trying to enter at the same area. So I try to have diversity in which parts of the market I'm trading, but I run the 20 models every day across 30 markets. Some of them I don't do over the indices, and some that I trade on the indices I don't do over my P24. But on average, you could say, I do 20 over 30 markets. And sometimes I could have 3 orders in the same market in the same direction. It does happen. It's just how it happens.
It's kind of designed not to. You're trying to spread things out over time, so that's an important design principle, but it could happen.
Yeah, like today I actually got, and I shouldn't say this, but it doesn't matter how experienced you are in trading, you can, some missed your rules. I went short the Japanese yen overnight, and I had an entry, a new entry that came in, which was just taking out the low of the previous day's bar's low, right? So that's the closest entry. I also had a previous order sitting in the market that's been there for a few days, which is a bit lower, of a different signal. Now, my rule is that when I have a concentration of orders in the same market on the same day in the same direction, I only allow myself to take the signal that will get executed first. So if I have 3 models saying sell the Japanese yen overnight, I'm not trading 3 signals overnight. I go, which one? I'll get my which one's closest to the market. I go, that's the one I should trade. So I put the new one in, which is taking out the low of the previous 24-hour bar, and I kept my other one in, thinking that's okay, because if I get, even though I'm short the Japanese yen, if I get a similar order the following day in the same market in the same direction, I will trade that, so I can actually build up my position in the Japanese yen. As I mentioned to you, with my money management, I don't look to add multiple contracts to individual models. When I can afford to trade more, I add more models to my portfolio of strategies.
Yeah, we'll get to that.
Yeah, so basically, I woke up this morning and I've short 2 contracts, and I went, oh, that's a bit lazy. I should have paused the original order that'd been in there since Sunday night or Saturday, because I do it. They're like based off weekly stuff. I knew what happened. I was just lazy. Did it cost me money? No, it made a little bit of money, and I just closed it out. So right now I'm just short 1 contract, but because I trade a portfolio of models across all the markets, I can occasionally have multiple models looking to trade in the same direction in the same market. And when that happens, I've got to be vigilant and go, which one is going to be triggered first, and only ensure that one's in. I use interactive brokers. That should be the only order that's in there.
So I want to ask about that, but before I do, if you've got an order to go long and an order to go short, then I presume you leave them both.
Exactly. Because you don't know which one's going to win in the end.
Yeah, well, one could last a week, one could last a month. Two very different trades. So, okay, so this is an interesting concept. Two things come to mind and help me understand it. So, you build out 20 models, but then when you run them as a portfolio, individual trades could get skipped because of the nature of them happening on the same day as another of another model.
Mm-hmm.
So the first thing that comes to mind is there's some capital efficiency there, in the sense of you can like build out a quite a wide amount of diversification without having to trade like hundreds of positions. You're actually keeping the amount of positions lower so that you can trade with a smaller account this diversified portfolio. The other thing that comes to mind is how do you backtest for that? In my head, what I've heard is that you build the models and then you combine them as a portfolio, but then that's going to do its own unique thing that's different to the individual models. So I guess you would have to backtest that as a new supermodel and really understand the behavior of that, correct?
Exactly. So each model is treated individually. Each model has to survive on its own merits. And then you just hope that what you've done is not duplicating what you already have. And then you got to combine them together. So quite often what I'll do is I will run all the models individually and put all the individual equity curves down columns. So you can have 3 strategies, and each one makes $100. And so combined, they should make $300. But what I also do in my model is that if, for whatever reasons, 2 models have the same order on the same day in the same direction, then I tell my system we don't duplicate positions. We can only trade one position in the same direction on the same day. So my model will skip that trade. It'll record which trades it's skipped, on my system, so I know what's been dropped into the bucket. And then on the combined, what you'll find is your combined portfolio approach is not making $300 because you've skipped a few trades. It's probably making only, say, $280 because on some days, for whatever reasons, there's two models that wanted to buy in the same direction, but my model says, well, which one is going to be executed first, and that takes the precedent. Yeah.
So again, just the way I'm thinking about that is that you probably don't want to skip too many trades, and so you do make quite an effort to build these models so that they work in a sort of steady flow. And so when you run it as a back test, there's not too many skipped. If there was a lot of skipping of trades, it would really alter the shape of those initial strategy ideas.
Absolutely. What you'll find is very rarely will a mean reversion strategy, take out a trend trading strategy. It can happen. It can happen because, as I said, a lot of my mean reversion strategies are trying to trade in the direction of the trend. Gets in on a mean reversion, and that could happen on the Monday. And guess what? It's such a big rally that one of my trend trading models may want to go long on Monday.
Yeah.
And what my portfolio approach does is it ignores that trend trading signal because it got in later than, say, my mean reversion entry. And it happens. Ideally, in a perfect world, there'll be no duplication. No trades would fall into the bucket of being like a duplicate trade. But unfortunately, I haven't found the magic sauce for that. There is a bit of duplication amongst the models. It's just how it is.
With your position sizing, Brent, do you generally size your positions purely on volatility or risk parity, or do you have any extra overlay, like the conviction or the expected edge or correlation in a particular strategy?
No, I keep it very simple. I essentially enter off generally off a break of a daily bar, and probably for the majority of my trades, my risk is a daily bar. So, for example, if I want to go long, like last night, I went short the Japanese yen, and my stop today is basically the highest high of either the entry bar, which is the bar last night, or the bar before, and it's usually the setup bar. So the bar before, what's today? Oh, it's Friday.
Yeah.
Anyway, the bar before, that's where the stop is because it was higher than last night's high, and I went short on a break of its low that bar's low. So I'm so simple what I do, dead set. That the risk is generally 8 times out of 10 is just the length of a daily bar.
But does that impact the size, like how many contracts you
Oh
put
yeah,
on?
yeah, absolutely. The smaller the setup bar. So what I'm essentially risking a setup bar. So setup bar, there's a pattern there, right? And the last bar on your chart, I call that the setup bar. Now it's not that bar individually is the reason why I'm selling, but it's the last bar on the chart, right? It's the last bar of a pattern. And what I generally do is I'll enter on a break of that bar, which is setup bar, and my risk is an opposite break of that bar. So if I'm going short the Japanese yen, selling short on a break of that bar low, and my stop is a one tick break of its high. So I'm essentially, risking one bar. If that bar is a short bar, that means I can trade far more contracts because my risk is much smaller. If it's a huge bar, then maybe the risk is too high and I just leave it.
Yeah, okay. So your risk, your position sizing is generally that risk. You're calculating that risk. Does
It's
it kind of
based
average
off
out?
well, it's based on the market's volatility. What's the
Yeah.
market doing? Yeah.
Does that average out at like a certain percentage of your equity, like you're taking 1% of your equity that's being risked per trade or
Well,
something like that?
I try and risk less than 0.5% on any one trade because I trade so many models and so many markets, and it's basically my portfolio of models is my position sizing because I can afford to trade more models because my account's okay. That I just really trade single contracts on multiple models, and it's always I prefer that when I'm risking on individual trades is less than 0.5% of my account because sometimes I can have 5 trades triggered in one day, which means I'm risking 2.5%. Yeah.
When you're okay, so I'm interested in how you allocate capital between these 20 models. Since there's no, like with equities, there's cash involved and one can trade two different models or if they like, and they can basically say, well, I'm going to allocate 50% of my capital to model A and 50% to model B. So since futures don't really work in the same way as cash, how do you allocate your capital or your risk between those models? Is it a risk-based thing? Is it a correlation-based thing?
No, that's just really what I can afford. It comes down to the question of what's an appropriate account size. Sorry, what's an appropriate portfolio given your account, or given how much risk capital you're prepared to put into futures trading. What would be an appropriate portfolio size? What can you afford to trade? So it's like a $64 question. People want to ask, how do I start trading futures? And that's probably one of the first hurdles they need to get over is, well, how much risk capital do you have? Okay, and then once you've established that, then you work out what can you afford to trade given its futures. That's going to be a function of strategy, how many markets you think you can trade, and look at the historical performance. And to my mind, there's only 3 ways you can sort of work out what would be an appropriate mix of account size and size of portfolio. One approach is called the capital allocation. That if you think you can afford to trade, say, 4 futures contracts, then you think to yourself, well, what's the average amount of money I should have for each contract for margin? Now, for my P24 portfolio, because I had a look at this this morning, given IB's current margin requirements, the average margin requirement for my P24 portfolio, which is the most liquid futures contracts on the CME, is essentially $11,000. Right. So if you want to, if you think you can trade 4 markets, or you think you want to trade 4 markets, one approach would be, well, that's the average amount of margin. 4 times 11,000 is you probably want $44,000 if you want to look to trade 4 markets. Another way is capital preservation, which refers to drawdowns. So you with your back testing, you'll put a portfolio together. You'll have a couple of models. You combine them, and you'll look at an historical back test and look at what is the worst maximum drawdown. Is that something you're comfortable with? Are you prepared to suffer? A 20% drawdown, a 30% drawdown, a 50% drawdown. So depending on what drawdown you're prepared to, suffer, will dictate how much capital you should have in your account, given that collection of markets and models you want to trade. And the third one that I'm aware of is just the I suppose the total funding approach, which is a combination of the first two, right? So what's my worst historical drawdown? Say 20 grand. Well, I need 20 grand for that. How many contracts do I want to trade, and how much money should I have for each contract, which could be, say, $11,000. I want to trade 4 contracts. That's $44,000 plus, the worst historical drawdown, which is $20,000. So that approach would suggest you could possibly consider trading futures with an account with $66,000. If you want to trade, this hypothetical portfolio of 4 markets with a bunch of models that has a worst drawdown of $20,000.
Yeah. Okay. So I just want to reframe that, because I was going to ask about it separately coming up. But yeah, it's good to have that chat about capital sizing. So we're talking about how much capital you need in your account to trade futures. It's not as straightforward as stocks. You obviously get to trade on enormous amounts of margin. And then you've got to be able to fund that margin. But then as you are trading those futures, you can, if you're going to build up a portfolio, and the more diversified you want to be, the more contracts you've got to trade across different markets. I mean, there's a little more complication in calculating, well, how much capital do you need? So I like in one sense, the simplicity of saying, okay, well, you run a back test, and you start with $100,000. If you've got a 50% drawdown, excuse me, and you only want 25, you should probably be trading with at least 200 grand. I want to sort of come back to that a little bit. I've got a couple of other questions around that. I guess where I was going with my question around the allocation between the models is, like, say you had, a quarter of your models are trend following and a quarter are mean reversion, 3/4 of mean reversion, say. Is there any thinking around, like, okay, adding the next model, how many positions, how many contracts that next model will trade if it sits in this bucket or that bucket? So, like, if you're trading if you add another model to your portfolio that's highly correlated to one you already have, maybe you would allocate less to it or trade smaller on it than one that was very non-correlated. Like, what's the thought process around how much you allocate to each individual?
It's a good question. Model? Basically, I treat every signal equal. So every signal, I trade one contract, whether it's DAX or Quant, I trade it. Yes, there's like David and Goliath, and that's wrong, but in my portfolio, I'm happy to do it. It's a good question, and what you have to look at is when you run your portfolio, the back test of the whole portfolio, the crucial metric to look at is what is the maximum open positions. Right now, it should not be more than 30 for me, because I only trade 30 markets, right? And my model should be dropping out duplicates, right? But what I've found is, even though I trade 20 models over 30 markets, I've never ever had historically, more than 18 positions open. So I've got to be able to afford to fund 18 positions. Now, in my opinion, trend trading is the safest way to trade, even though it's the hardest way to trade. And it's the most efficient way to make money because there's no limit on your profit potential, as opposed to mean reversion, which has limited profit potential because you're looking for a reversion back to a mean, right? Now, so trend trading, in my opinion, if you have no success, the first thing you should try and crack is trend trading, not mean reversion, even though mean reversion is far more popular with the average profit trader because they think it's easier and it's got a higher accuracy rate because they generally don't trade with stops, right? Trend trading should be number one. The problem with trend trading, long term, it's heavy on your capital because you got to keep that, you got to fund that contract for a long time, and it does eat up your capital. So a good thing about short-term trading is that you do free up your capital regularly because you're in and my average hold period for short-term is 5 days. So I don't say, oh, that's model A, I'm going to give it 10%. That's model B, I'll give it 3% or whatever. I don't pick and choose. I just treat them all equally. They're all in a basket. And my objective is to trade a volatility neutral portfolio. So trend trading loves long volatility. Trend trading loves markets moving in and keep moving, right? Long volatility, they love it. Mean reversion hates long volatility because they're getting stopped out at catastrophic stops, right? Because market's moving up, they keep selling it because the market should mean revert, it keeps going up. So trend trading hates range-bound markets but loves, trending markets. Mean reversion markets love quiet markets. Mean reversion loves range-bound markets. Trend trading hates it, right? So if you can neutralize the volatility, if you can neutralize the long and the short, then you have a volatility neutral portfolio. And that's what you achieve with having a portfolio of trend and mean reversion strategies. Now, mean reversion is very inefficient in making money because you have to put an estimated stop in place, even though you don't. For those mean reversion strategies that don't use stops, they still have to put an estimated stop in because of your position sizing. Right, you're just not going to trade blind and just hope that the market will come back because mean reversion says it will come back. Right, there's got to be some estimate of a stop, right? And so you'll find that those estimated stops are quite large because that's how mean reversion is. You sell a rising market, and in time it probably will mean revert and you'll make money, but you just don't know what time does, how long it's going to take. You got to estimate a big stop. So it makes it inefficient at making money. Trend trading, you know exactly where your stop is because, it takes off and you want it to keep going, but 6 times out of 10, seven times out of 10 will just reverse and stop you out. For me, I only risk a single bar. It doesn't cost me anything, just 0.5%. No big deal. And so it's far more efficient at making money. But where mean reversion comes in, because trend trading is basically a lot of losing. Yes, you win big, but you lose a lot regularly. So the mean reversion pads out or fills in the dips of trend trading. So It's funny. Mean reversion, very inefficient at making money, but very useful in making it easier for a trend trader to basically suffer all those constant losses along the way. If that makes sense.
It does. I think what I'm getting out of it that's quite interesting, that's similar to what I do with equities, is that you're adding strategies to essentially fill gaps or fill potholes in non-correlated ways to what you already have. You're kind of designing the next strategy with a particular purpose, and then you're just equal allocating across all of those strategies, really sizing them or allocating capital, if you could say that, to each of them equally, because you don't know what the future is going to hold and you're not relying on historic correlations. Each of them are meant to be robust in their own right. So you've built the portfolio in a very design-led way. So you just keep adding the next thing that's relevant to that portfolio, and then everything gets an equal spread. Is that a fair summary?
Yeah, it's treated equally.
And so that leads us nicely into, a hot topic that I want to get into with you a little bit, because you trade differently to some of the shorter term futures traders that I've had on, in two regards. One, you're longer term in the sense of really relying on daily bars or more, which I love the simplicity of. And the efficiency of. Actually, I want to ask about that model efficiency as well, because you mentioned that at the outset, but I'll come back to it. But Bob Pardo, Kevin Davey, Andrea Unger, all these guys who trade minute bars, hourly bars. They trade a bit shorter term, but they also are very reliant on a philosophy of building strategies that are expected to decay, that are not expected to last forever, quote unquote. And so they have a system, a meta system that is constantly letting the cream rise to the top. They're trading the best strategies that are most in favor this month, this quarter. And when they they have a very strict rule process about when they fall out of favor at the end of this quarter or even month, and then the next strategy comes in and starts getting traded. Now, you're very different to that in the sense that you're really building strategies that you believe are robust and should not need to be tinkered with, and you leave them alone. So talk to me about how you landed on this philosophy of really building strategies that last forever.
Well, by accident. I know I was sitting in Shenzhen with Andrea Unger. He was speaking before me in Shenzhen, and we were just sharing ideas. And it's amazing. It's amazing the number of patterns he has. And he's a great believer that every market has its own little idiosyncrasy, and that's where I was too at the very beginning. Being in Australia, I was at Bank of America, and I ended up being the manager of the 90-day bank bill futures. So I was responsible for trading the short-term 90-day interest rate futures. Now, being a bank, you can't trade in any products that the bank does. And so what we all did, FX, the cash desk, the security desk, we all punted the Australian index contract, the SPY.
Mm-hmm.
And so that was my first introduction to the markets. And I was part of I'm not sure what you call it, a room. It was called Wave Traders. It belonged to David Hunt.
Like a forum back in the day.
A forum, yeah. It was about 2,000 members, and it was a lot of fun. And I was one of maybe 5 or 6 guys who would post, live real trades, and would have all the, Fibonacci stuff, for price and time, and Elliott count, and it was really quite exciting. Anyway, one day a gentleman joined the forum, and this gentleman used to be the general manager of what was at the time the largest trading education business in Australia, and their pitch was to teach the secrets of GAN. And back in the early 90s, mid 90s, when we had this forum, GAN wasn't thought of very highly, and we were quite dismissive of GAN, and we mocked, GAN. And when he turned up, he posted something, and I got upset, and I just said that I don't know what a 1940s chart of corn has to do with the All Ordinaries and our SPY contract in 1995 or 6 or 7, whenever it was. I accused him of basically looking to go fishing for customers to promote a new business he was setting up. Yeah. And so I declared that I'd go off and get myself licensed, develop a really simple mechanical model, make it available to people, and show my real-time results. I did that for 15 years. And that model originally was called SPY Trader. Now, what's interesting, it's a long story to get to this point. All I traded was a SPY. And my little simple SPY Trader model consisted of 8 patterns. And everyone, loves seeing the results each month going up. My account balances was going up. SPY Trader. It was 8 patterns. Anyway, no one knew there was 8 patterns. It was just called SPY Trader, simple mechanical daily bars. Everyone kept asking me from overseas, how does it work on the E-mini S&P? And I said, I don't know. I don't trade the E-mini. How does it work on the Nikkei? I don't know. What's the Nikkei? How does it work on the DAX? What's the DAX? I'm in Australia. Anyway, I got all these questions about, does it work on all these international indices that I learned that they were, indices. And I got curious. And so I got some friends who basically started their own little hedge fund. And I asked them for data on the SPY and the Taiwanese. I used to trade the Taiwan, but don't anymore. Hang Seng, Nikkei, the FTSE, the DAX, E-mini, NASDAQ. I didn't do the mini Dow because I was curious. So I ran the model. This is SPY Trader, just designed for the Australian market. And what surprised me was 4 out of the 8 patterns were fantastic, like shooting for the moon. The other 4 break even, flat line. And that got me thinking. And it got me thinking that, the 4 that work on markets which are basically out of sample, I didn't know that term back then, but I thought, God, a pattern that's independently developed on a local market can work on an overseas market would suggest that pattern's quite strong. It's quite robust. And then basically I changed the model. I changed the name to from SPY Trader to Index Trader.
Yeah.
I basically dropped 4 of the patterns, and I just kept 4 patterns, and I applied it over an international portfolio of indices, and that became Index Trader. So that's where I got the idea of robustness, where one of my key screens is that any idea I come up with, it has to be versatile enough to work across any market. That's like a key sign of robustness. So that's where that idea, and I've embraced that since the late 90s.
Yeah, and for those who've been following the pod all along, I did a lot of the early shows with Rich Brennan, and he would have loved this. A shout out to Rich, I guess we both have that philosophy that as much as possible, one should seek to trade something that is robust across the markets, because there's just so little data available. So the more out of sample testing that you can do, and the more cross market validation you can do, you're really adding to your confidence that your model is robust. So, I mean, with futures, of course, to give the other guys their due, they would argue that they're often quite such different products, with different fundamental drivers. A cattle farmer's got different priorities and concerns than a gold miner. Are there, when you do a multi-market test, so let's say you're building a model on gold, and you want to make sure that it's robust, so you see how it goes on the other markets, but do you have some metrics that you would apply so that you would expect it to pass a certain pass level on those other metrics, but it doesn't have to shoot the lights out? It's probably going to do better on gold than the others, but it should still perform okay. Is that a fair assessment?
I do design things that are basically robust enough to contribute across all markets.
Yeah.
Not every market, but the majority of markets. Some of my ideas, this is an example, never have made money in wheat, but I still trade it with wheat because you just don't know, when things are going to take off. So we're all different, and like there are so many different ways to trade. So it's really important for people to understand that there's so many different ways to trade, whether it's discretionary or even mechanical. And I'm completely different, poles apart from Andrea, how he trades, or Kevin trades, and they're very successful. My psyche is that I want something that's hopefully bulletproof, right? Because there's no guarantees. Because I can tell you, when you're in a drawdown, and you have drawdowns, and recently I've had 2 back-to-back drawdowns, one in 2021 and then one in 2023. And I can tell you, when you're in a drawdown, you start questioning your faith in your strategies, right? And you look at it and you twist your head and you twist this way, and what's happening here. Is this just a nasty drawdown, or has it become so fragile that the equity momentum has going from positive to negative, and maybe permanently in a negative? It really questions you. And so if you can have an idea that you have good reasons to know what's robust, it just gives you that extra faith that, you know what, I'll just keep my risk at reward 0%, trade small relative to my risk capital, and, you know, I should see new equity highs at the end of the day.
Yeah.
And I get my confidence from knowing how I built my models and where they've come from.
Right. So, though that index trader you had, Brent, with the 8 patterns, is that still running today? How much have you had to change that since then?
Oh, I can tell you. Well, I left
Or the
4 aside,
4, yeah, the primary 4.
and one of those ones I left aside. I actually shared it with the Australian Technical Association's Newcastle chapter back in 1998, 1999, and it's still kicking out the lights. Um, uh, yeah. So they still exist. They're in drawdown. They're currently in the drawdown. So I'm not trading it right now. So I do watch my individual models and look for equity, measure the equity momentum, and if it's negative, I put it aside. So index trader is probably like 27 years old now. It's on the sidelines. Yeah.
But it's still relevant. It's still in the portfolio.
Yeah.
So let's come back to that, because that's another topic. If things can go into the sidelines, go into the sort of sin bin for a moment. And also I want to ask about, whether you ultimately do retire strategies and the process around there. But just let's talk about your whole strategy build process. So we've established that you want to build strategies which are robust and work across multiple markets. Multi-market testing is a fantastic robustness test, gives us a lot of confidence. So you want to build models that you feel are going to stand the test of time. You're looking for things that are not going to quickly decay. Lead us from idea through to implementation, I guess, high level first in that process. Like, what's your philosophy driving that?
Quite simple. I'm just looking for evidence that something works. And so my little bit of secret sauce, that what I do is I ignore anything that's new because there's no evidence at all that it's worked. Doesn't mean I may not be curious if a brand new idea pops up, somebody talks about something. Doesn't mean I'm not curious. But essentially, I focus on old ideas. So I'm essentially a treasure hunter. So I just research and read old things. And if something takes my interest about an old idea, I'll code it up and see whether, what may have been discussed in 1990 or 1980 or 1970 or 1960 or 1950, whatever time it was released, I code it up and I have a look at it. And, basically I spend a lot of time coding up old ideas that gives me nothing. But occasionally I come across a nugget of gold. I jealously guard that nugget of gold, and I'll put that into a strategy. And so I know that basically my data starts at 1980, and my Norgate data. And so any idea that was publicly released, before 1980, will really, all the equity curve that you see is all out of sample. So essentially, my secret sauce is I look at old ideas, and I know it's unfashionable. I know it's not a new shiny object that's going to distract all the magpies and get them all excited. Boring is there's an expression for that which I won't repeat. But to me, it's the golden gift to you and I as evidence-based traders.
Because it's been around and stood the test of time.
Yeah, and there's no guarantee that particular idea will continue to work in the future. But by geez, it gives you a lot of confidence that the odds are stacked in your favour, that idea will probably continue to work well into the future. Will it be perfect? No. Will it have drawdowns? Definitely. But it probably will enjoy regular new equity highs. So my whole thing is I basically look for old ideas. Go straight out of the bag. I've got all of that out of sample evidence. Now, in addition to robustness is key. That's the whole thing. Robustness is key. It's just if robustness comes with marvelous, what I call marvelous metrics, even better. But I'll always give more credit, more attention to robustness than some of the poor metrics, right? Yeah, and I just basically look for a lot of out of sample old ideas.
But so we're talking about things like the turtle strategy and
there you go, yeah,
old Davis boxes and Bollinger Bands and Keltner and
Davis
Dow
box,
theory
right?
and
1950 Dow theory, 1900 Jesse Livermore's reaction model, 1900. You got Cowell's monthly close model, 1933. You got Richard Donchigan's four week rule model, which the turtles piggyback on top of. So it's actually an earlier strategy than the turtles. 1960. I mean, that's like 60 years old. The turtles is better than the original 4 week rule model, but give credit where credit's due. But the turtle strategy, it's so simple, and it's been out since 1983. I think that's when Dennis and Bill first taught it, 1983. And one of the things I talk about in how I develop my ideas. So you asked me how do I start it? Well, I started off by just basically looking backwards. And my recommendation is look at all books that are at least 20 years old, so that if you read a book that's 20 years or older and the idea resonates with you, program it up. And if it's got legs, wow, you got 20 years of out of sample data that can boost your confidence, and you can maybe work with. So that's where I will start. So old ideas, and along the way, I know that key attributes of robustness is what we've mentioned before. Versatility. Does the idea work across a broad, diversified portfolio of markets? It doesn't have to be profitable in every individual market, but overall, it's got to be profitable. And then it has to follow, good design principles, which
good
is
universal principles. Would you say? I mean, that's your book, Brent.
Yeah,
there we go. Universal principles of successful trading.
Yeah. So it's got basically simple strategy, few rules, few filters, and few variables. Right? I'm not a big fan of indicators, because once you build your strategy, what you also need to do is, and I do use indicators. I use a 200-day moving average. That's got a variable, 200. I use an average true range. That's got a variable in it too. Whenever you have a variable in a particular model, what most people probably intuitively know this, but it's good to actually articulate it, that particular model of yours, if you've got even just one variable in that model, it has a parallel universe of alternative models, right? Alternative equity curves. And you need to know how sensitive your equity curve is to changes in the variable value. And not just the variable, the equity curve, but what impact it has on your risk of ruin, right? And when I adjust variables, I basically just do 4 adjustments, which is probably a bit too, not conservative enough. But I do 2 10% adjustments above the value and 2 10% adjustments below the value.
So we're talking about variance testing, if you like. Now we're talking about taking the parameters that are in our model, stress testing them, up and down, which is obviously creating a wide array of equity curves. And then you would use that then to reassess your metrics and your risk of ruin.
That's right. You got to look at every individual equity curve, and any individual equity curve that has a risk of ruin above 0%, walk away. It doesn't matter how confident you are that you'll never change the variables. People always change the variables.
Well, and we don't know what the market's going to throw out tomorrow, right? So there's no point running the single back test. We want to look at as many as possible to get the best possible idea of what could happen in future. And what I like about what you're saying too is you're trying to break it. Like, what's the worst case scenario? If the worst case scenario is you could have a risk of ruin greater than 0, then
just walk away.
walk away. Yeah, so it
And
establishes really.
there's so many old ideas to keep us busy.
Mm. Do you so you've got this kind of couple of really important principles there: multi-market, that validity, that an idea is valid over multiple markets. There's the standard variance testing and stress testing, if you like, and particularly focusing on worst case scenarios and trying to break it. I think that's also great design principle. Are there any other sort of classic robustness tests? Do you keep data out of sample? Do you do walk forward analysis? Do you
Mm,
do
mm.
Monte
Yeah.
Carlo, etc.?
I don't do any walk forward. I don't do any out of sample because all my stuff is so old. It's all out of sample anyway. I don't have an original model. Uh,
Mm,
some stuff I've done is my stuff, but then the ideas I've introduced to an old idea, guess what? They are also old themselves. Does that make sense?
mm,
Yeah. So I'm like a junkyard collector.
mm.
Well, it's not junk, I find gems and I'll put them all together. So I don't do a walk forward because I feel that my equity curves are basically all out of sample. That presentation I did with the Australian Technical Analysts Association just a month ago, where I basically took a really old and simple idea like Dow theory, and and all those equity curves you saw, they're all out of
Out of
sample.
sample. Mm.
Right? You know, can you do better than those raw equity curves? Of course you can do. But for many people, whatever they come up with will never be as good as a simple Dow strategy because of its provenance, because of its integrity, because of its history, right? It's just old and robust. So yeah, um,
Makes
there's so
sense.
many ideas out there just to get you started.
Do you follow a strict process once you sit down to do that, or it's allowed to be fairly loose because by definition, it's design led anyway?
Well, everything I've done has really been done by accident. Like I didn't think back in 1998 that I'm going to just look at old ideas and just work back, go back to David Ricardo in 1838 and take his original idea and just work forward decade by decade and go through all those books. Um, I just know that that's how it's all. How I do it today is I just basically look backwards, keep it very simple, um, minimize the indicators, minimize the variables, and make sure I do what I call an equity curve stability review, which is you term it as stress testing it, and just know that given the number of variables that you have across all your indicators and the number of adjustments that you want to make, that the more adjustments and the more variables, that the size of your parallel universe of alternative equity curves grows exponentially. So,
Yeah.
for example, if you've got a strategy that has four variables, and you probably, bit like me, maybe not as conservative as I should be, but I just do two adjustments up and two adjustments down, and you've got to do that all across each individual variable. But when you keep three fixed and you adjust that one,
Mm.
by 10% and by 20% and down to 90%, down to 80%, and then you put that back to where it was, and you do this one, and this one's basically four variables with four adjustments. Basically, creates 256 alternative equity curves in your model's parallel universe. And for a lot of people, four variables is not much.
No.
They have a lot more than four variables. And so they're just, a lot of people just unaware of this universal uh, uh, parallel universe that's out there, mimicking their strategy with all these alternative equity curves
Yeah.
because they've got so many different variations.
Brent, you also talk about having a strategy benchmark for performance, and I think that's a good starting point as well
Yeah,
for
that's a
people.
great point. Yeah, because we want to avoid falling into the risk of being irrelevant. So, a big challenge to people is revenge trading. We lose money and we're successful people, and we're successful because we don't give up and we're determined. And I've had a nasty experience in the markets, but I'm not going to give up. I'm going to get it back. And you start taking on extra risk. And that's obviously a death loop. Down you go. Another one is that people put so much time and effort into trading that they want to be relevant, and so they can only ever consider trading their own ideas. So I recommend to people that when they develop strategies, they should have a benchmark that they need to beat. A benchmark for trend trading, a benchmark for mean reversion trading, a benchmark for some option strategy, whatever they may do, right? And that benchmark is the Rolls Royce. That's what you have to outperform. And one benchmark I recommend for trend trading is the turtle system. And most people, if they're true to themselves, cannot beat the turtle system because of its provenance. It's been out there since 1983, and if you look at its true heritage, it's actually 1960, and it's based off the back of Richard Donchian's 4-week rule model. So it's royalty. It is royalty, right?
Mm-hmm.
Not only is it royalty, but it's so simple. You just go long on a 4-week breakout, and you stop as an opposite breakout on a 2-week or 10 bar or 2-week channel, right?
There's a website called 40in20out.com.
So simple, so simple.
Tracks it, yeah.
And not many strategies only have 2 rules. With 2 variables, a 4-week entry and a 2-week exit. You know what I'm saying? And that works across, a diversified portfolio. Like, it's absolutely Rolls Royce. So I recommend to people, still challenge yourself, develop your systems, but just measure what you're doing against the benchmark. And if you haven't got a benchmark, I'd certainly encourage people to look at the turtle system, because it's royalty in terms of its provenance, and it's magnificent in terms of its simplicity. Just 2 rules.
A couple more questions just to round out the strategy thing, Brent. I mentioned I wanted to come back to that efficiency a moment ago. So what do you mean by strategy efficiency?
What I'm talking about is how good is it at making money? Now, in my hierarchy of needs, my first objective, survival. So I want to know what my risk reward is, and it's got to be at 0%, right? And then that's my first hierarchy of needs, is I need to survive. And my last hierarchy of need is I know I'm in this business to make money. So I want to know, is it an efficient machine at making money? So it's no good looking at a single unit or single contract equity curve. If you look at the Golden Cross and the Death Cross strategy, which is a 50-day moving average over a 200-day moving average, and you run that over a diversified portfolio, its equity curve on a single contract basis is picture perfect. Picture perfect. You'd be going, oh my God, it's got provenance. It's really old. It's nothing new. Very simple. Sure, it's got 2 indicators. That's 2 variables. But why would you change them when they've been working for like a long time? I'm not sure when it first came out. It could be the 90s or the 80s, but it's old, right? But is it efficient at making money? Now, I mentioned to you the other day that on a single contract basis, the 50 and 200-day dual moving average strategy across my P24 portfolio and net of brokerage makes about 1.7 million, right? Fantastic. Now you compare that to the turtle system, same portfolio, simple rules, same period, it only makes 1.4 million. And if you compare the equity curves, the turtle equity curve can get rough. It can get rough. While the 50 and 200-day moving average strategy, it's a picture perfect equity curve. Question is, which strategy? This is the trick question. Which strategy do you want to embrace to trade? Is it the nice picture perfect equity curve, or the rough turtle one?
I want to just quickly interject, keep the thought, but where you're going is like, now we've got to actually allocate real capital to it, allocate risk, and then compound our capital over time.
That's right.
So how does this help us measure? So explain that to us.
Yeah. And essentially, you want to know how efficient is how you come down to determining who's the winner of the competition. don't be fooled by the cover of the book. Don't be fooled by its attractiveness. Yes, the 50 and the 200-day moving average equity curve is picture perfect. It's a postcard. Of course, you'd buy 10 of those, right? But don't be fooled by that. You want to look under the hood to see how efficient are you at making money when money management is applied. How good is it at earning geometric profits? And what you'll find is that the dual moving average system, the 50 and the 200-day moving average system, because it's got enormous stops, every time you get a new signal, because the stop's so big, you can only afford to put a small position on relative, say, to the turtle system, where its stop is basically a 2-week stop. Now, in my opinion, that's a big stop. But compared to the 50 and the 200-day moving average, strategy, it's a much smaller stop. So if you've got the same capital, right? You've got the same capital, I can risk $100 today, right? I've got a choice, the golden cross system or the turtle system. Well, the big stop on the 50 and the 200-day moving average system is actually $100. So I can only afford to put one lot on. But I'm looking at my turtle system, and the 2-week risk on the turtle system in the same market, for example, it's only $25. I can put 4 contracts on. I can afford to risk $100 today. I can actually put on 4 contracts for the turtle system on that market. But for the 50 and the 200-day moving average strategy, because the risk is actually $100, I can only put 1 contract on. So they can both be stopped out, and you both lost $100. But if they both take off, who's making the most money? Turtles or the 50 to 200-day moving average strategy? And it's a turtles because it's more efficient.
So you got more contracts on. So, and this is a futures specific concept too, in a sense.
No, it's not at all. It's
it's like you're building a back test on a single contract, right? So naturally, it's a 2-step process that we're going to apply. We're going to allocate a certain amount of capital to that, and we're going to compound our capital. And it also, when we talk about the size of those stops, that's one thing. But I'm picking up that the other part of that is the frequency of trading.
Yeah. Well, certainly frequency, but it's about your position sizing. Now, you interviewed Jerry Parker. He's a famous turtle, done really, really well. I'm sure he trades futures, but he could also trade the way he trades on the share market.
Yeah, he does. Yeah.
Right. With trading, my book, My Universal Principles of Successful Trading, in my opinion, it's all based on following a good process, right? So the process that we follow is primary to whichever markets we want to trade and whatever instruments we want to trade, whether it's CFDs, shares, futures, options, shares. It's tertiary, right? But even when you decide to actually engage with the market, the risk is the same across all instruments. You've got $100 you can afford to lose today. $100, whether it's on a futures or a CFD or a share or an options, right? You'll have an entry and a stop level. That's your risk. How many units can I put on given I've got $100 and my risk? And that's what I'm talking about. Efficiency tells you how good a strategy is in building up position size, and it's always a function of your stops. So strategies that have smaller stops will always be more efficient than strategies with larger stops. You're risking the same $100, but because you got such a small stop, in my case, I only risk a bar. That's why it allows me to buddy trade 20 models. I probably at the moment I've got 4 open positions, but my open positions range between 5 to 15 generally.
So this triggers the thought of the granularity of futures too. So I guess to have the capability to be able to trade the 4 contracts with the turtles versus the 1 on the golden cross, it means you need to have a certain amount of capital at hand. So we talked a bit about working out how much capital one needed. The other consideration here is that with futures, the size, the nominal value of the contracts is so large that to just step from one full-size contract to 2 to 3 to 4 is quite a significant amount more risk that
Well,
one has
your
to take
margin
on.
goes up, but as you mentioned, you get a lot of leverage in futures. So even though the face value of a futures contract could be, say, for example, $500 million, but you just need a margin of $10,000 to trade it. But you can afford to lose $100 of that margin. Does that make sense? So you get that benefit.
Do
Trading.
you? Yeah, but obviously, do you trade the micros or the minis or anything, and do they have sufficient liquidity for those who've got smaller accounts and who want to be able to compound that much better?
No, I don't trade the minis, but I watch it, and because I'm involved in education and people have small accounts, I'm keeping an eye on it. And the micros have been building really well over the recent years, not only in the spread of contracts, but the depth. Their volume's improving. Some of them are very scratchy, and you wouldn't trade it, right? But it's improving all the time, and all the popular ones like gold, oil, the Nasdaq, the Dow, the E-mini. On my website, I've got a list of showing the daily volume for one day. Fantastic.
So this, what fascinates me about this with futures as well, because I don't do this yet because I'm not a futures trader yet, but when you're back testing, it's standard practice to do this back test over a single contract and then start to add capital after that. So how does one do that? And have you built into your system a sort of slow compounding whereby, do you trade with a single contract? So step one is you run a 30-year back test on a single contract. Okay, you trade one contract the whole time. Reality is over 30 years, you've made a lot of money, so you're going to trade more than one contract over time. So how do you build in and can you automate this with your software? How often do you increase your position sizing based on your capital growth?
What I do differently in terms of money management, I don't look to add extra contracts to my signals. I look to add extra strategies to my portfolio of strategies. Right. So I started off originally with just SPY trader that became index trader. And then as my account grew, I basically added trend trading, and I built a system called Key Level, back in, and I released that publicly in 2008. And it's something I was trading a portfolio of markets. So I just look to add extra strategies when I can afford to trade more contracts. Does that make sense? Because diversification works. Diversification works. And as a really simple illustration is that nobody can expect one single strategy to make money every year in a single market. Maybe it does exist out there. I don't know it. And so you want to avoid a single point of failure in your approach to trading. You want to avoid a single point of failure. So by trading multiple markets, if a black swan event comes along and whacks the indices, well, that's going to hurt me. But I trade a diversified portfolio. I may be long a trend trading signal on the S&P and the market shits itself. I get stopped out. Well, that's going to hurt. But, I've got positions in other markets that probably are reacting. Diversification works.
With on the diversification track, obviously you're building models that are intended to be non-correlated, and you're also someone who builds these models that are intended to last for a long time. So let's say you've got two non-correlated models, a mean reversion and a trend. Do you find that level of non-correlation also tends to persist into your outer sample, into your live trading, or have you seen those things diverge quite a bit?
No. It bloody works. Be volatility neutral in how you trade. Yes, have a strategy that enjoys movement. That's long volatility. Also have a strategy that enjoys short volatility, goes nowhere. I recently had a mean reversion position that buddy was kicked me in the groin, right? Like on an individual. But wow, my trend trading stuff made up for it. It was net neutral.
Yeah.
You know, as I mentioned before, it's embrace risk, the idea of risk reward, understand how that is calculated, and what you'll learn is it's two main things: how much you're prepared to risk, right, of your account balance, and your edge, right, your edge. And when you drill into your edge, hopefully you'll come to the conclusion that essentially what you and I do, we are just volatility traders. And guess what? All markets are the same. You can peel off, you trade shares, so peel off Tesla, peel off Nvidia, peel off what other shares to trade, BHP, make them naked, right? And you jump into their time series and you'll discover something that's quite extraordinary. And what you'll find is they're all the same. Similarly with what I trade in futures, and I trade 8 sectors. So I trade indices like S&P, the Dow, the Mini, the DAX, corn, sugar, lean hogs, oil, heating oil, natural gas, gold, silver, copper. I trade them all, right? When you make them naked, and even though you look at their charts, and some are doing this over 20 years, and some are doing this over 20 years, and some are doing this over 20 years, and you think, Brent, they're all bloody different. I'm telling you, they're not. All markets are homogeneous. Look at the internal closing streaks of every market. And what you'll find is that the standard deviations of streaks is almost identical. And what you'll find is a standard deviation of closing streaks across all markets for one standard deviation is 2.4 days. And if you don't believe me, have a look. And not only in terms of a big fat portfolio, people could say, well, Brett, that's an average. And we know average, you lose a lot of granularity, right? I agree. So look down some verticals. Look at your data on decades. My data goes from 1980, so you look at 1980s, 1990s, 2000, 2010, 2020, right? Look at what the standard deviations of your closing streaks of all these different markets. And I trade 30 markets. I can tell you, you go between them in the 80s and 90s, it's all like 2.4, 2.5, 2.6, 2.3, 2.4. Unbelievable. And you go, oh, yeah, Brent, but that's also an average. You've bundled everything in together. You've got crude oil with bloody pork bellies, and you got sugar with silver, and, yeah, I don't believe you, Brent. Fine. Pull that all out. Drill down per sector. And you'll see that the indices are 2.4, interest rates are 2.4, currencies are 2.4, sugar, oil, 2.3, 2.6. There's a small movement, but basically the average, so 68% of all streaks, pattern streaks. And remember, my light bulb moment was in the late 90s when Jeff Morgan said to me, well, Brent, the SPY has just completed its medium move, which is three higher closes. I'd expect the market to reverse. I'll be looking for a place to sell, and down it went, right? It's in the time series. The math does not lie. And do you know George Taylor? George Taylor was a famous grain trader back in the 30s or 40s, and he wrote a book. He had a technique called the book method. And he wrote a book about his method on being a pit trader or floor trader on the Chicago Board of Trade in the US. Now, it's a very difficult book to read. It doesn't write particularly well. But his secret sauce was that he believed the market had a 3-day cycle. So he just label every day a buy day, a sell day, go short day. So on the third day, you go short, a 3-day cycle. To me, it's like all markets are the same.
Yeah. It gives you a lot of competitive optionality because you, in a sense, you've normalized it all. You've now got a lot of data to look at, and you're seeking to find only those things that are universal across.
And that's why good strategies work across all markets.
I have a similar approach.
You haven't drilled down into the idiosyncrasies, and markets do have their individual idiosyncrasies. I don't deny that, but I'm just big on just robustness and just not having
and ease of use, right, Brent? Because you don't have to You don't have to muck around very often. Like, you just set these things to go and let them run. I want to jump into a couple more things before we wrap up. We've already been talking for over an hour and a half. So your strategy review process, you did talk about sidelining strategies before, and you have talked about a model kill switch before. So what what's the nature of this trading the equity curve, and what's the nature of turning strategies off?
Yeah, it's a good question. Even though you can think you've done a good job in finding, a gold nugget somewhere, and you got great confidence that it's 60 years old, 20 years old, 30 years old, that it will continue to work into the future. Just like a trading system or a trade has a stop, a strategy needs to have a stop. You need to know when it's time to put it aside to stop yourself out of the strategy. I call that a kill switch. And essentially, you just need to measure your equity momentum. And there's no, just like in trading, there's no right or wrong, no right or wrong stop. There's no right or wrong kill switch or way to measure equity momentum. And what I just tend to do nowadays is around Christmas time, when I usually shut down for this in December, and we do a few things with the family, and that's my reflective time. And I basically will run all my equity curves of all the models, and I just visually spot the equity curve, and I just look to myself, does it look good or look bad? And I've got a number of them switched off, and they'll stay switched off until Christmas, and I'll run the equity curves again. So it is just really designed to like a health checkup of your strategy. Now, if I'm trading a strategy and it's killing me intra-year, I won't wait until December to switch it off, right? But usually I don't reignite them until Christmas.
So this is your discretionary side, if you like. You've got a little bit of art coming out to the science that all of us. Well, I also like to think I reserve the right. I'm very hesitant to do anything on a discretionary basis. Every time I try, it's a disaster. So I basically rule it out. But at some point, all of us are still making the decisions to roll strategies out and new strategies in with a limited amount of capital. And just one other question on that, I suppose, is, have the markets changed over the years? Like, what does that mean for your ongoing research efforts? Like,
mate, that's a great question. I get asked that all the time because we see changes, and they love, people. Some stuff that I say resonates with people, and they're curious, and they want to, But the question is, it's done well in the past, Brent. What's the guarantee it's going to do well in the future? Because, my God, markets are changing, and Trump opens his mouth,
and some things have fundamentally changed. Commissions have come down, for example. Spreads might have tightened.
So it's a great question, because what I tell the people is absolutely the markets have changed. You're right. You're talking about commissions that come down. Historical data is really, really cheap. I know when I started trading, when I got a little Hutchison pager on my belt, I was walking around on the page. I thought I was the duck's guts.
Oh, yes.
I was just the whiz bang, But today you've got mobile phones where people can trade off their phones, and markets are almost 24 hours now. You got new instruments, you got CFDs, you got cryptocurrencies, you got micros and mini contracts. Of course, the markets have changed, but then I say, and also people usually say, but oh my God, you had the internet bust in 2000, and you had the global financial collapse, and then you had COVID, and so much volatility, right? Haven't the markets changed? Well, my simple answer to that is I agree it has changed, but it hasn't changed. The markets have not changed. You drill down into your time series and look at the last 5 years, 10 years, 15 years, and calculate what the standard deviation of the closing streaks are. 2.4 days. 2 standard deviations, 5 days. Things haven't changed.
Measure the things that haven't changed.
Nothing's changed. The markets basically volatility has always been in the markets, right? You know, all we see is different labels, right? Like, you know, in 87, we had the share market crash. In the early 1990s, we had the savings and loans disaster. And then we had the Asian currency crisis in the late 1990s, the tech boom bust, you know, the global financial crisis. Basically, the world or the markets, and I learned this first from Larry Williams, even though when I learned it off Larry Williams, I hadn't sort of projected it onto the bigger picture, right? But there's only one reliable cycle in the market, you know, only one reliable market, and that is you have small ranges are followed by large ranges, followed
I
by
remember him
small
saying that.
ranges,
Yeah.
large ranges, right? So it's basically a volatility cycle. And I mentioned before, we are basically volatility traders, and that's why it's important to trade a volatility neutral portfolio. And so what you see, all that volatility is there's a cycle of stability, small price changes, instability, large price changes, followed by stability, instability, stability. And that's you know, hasn't changed. It's just the labels change, the characters change. And if you don't believe me, have a look at Richard Donchian's 4-week rule model. It was publicly released in 1960s. So it's been out of sample for, 65 years, right? Well, certainly on my P24 portfolio, it still, to this day, is enjoying new equity highs. Has there been volatility along the way? Of course there's been volatility. But if you manage your money properly and you have proper money management and you trade small relative to your risk, you trade small relative to your risk capital, you would love to enjoy that equity curve. So when people say markets have changed, and they're actually adamant it's changed, they can see it. They can see how, you know, the Hutchison pager has come and gone, and there's mobile phones, there's trading 24 hours a day, there's cryptocurrencies, there's quantitative easing. You know, there's this interference with the markets and all that. And I go, yes. On the surface, it's changed, but you dive into the data and just look at your closing streaks. Simple stuff. Have a look at it. Has the standard deviation of closing streaks changed at all over well, certainly my data, which is 40 years? And I say, well, Brent, that's only 1980s to, you know, last 45 years. That's sample size is not large enough. I don't believe you, Brent. Well, I'd go, remember the guy called George Taylor? You know, he was a prominent grain trader on the Chicago Board of Exchange in the 1940s, and he wrote a book. And what he recognised, there was like a 3-day cycle. That sounds suspiciously like a standard deviation of 2.4, you know, and George Taylor would say, and occasionally the 3-day cycle would extend to a 4th day to a 5th day, you know. And you look at the equity curve of the 4-week rule since 1960, and it's still enjoying new equity highs. So yes, on the surface, it's changed. So acknowledge that, but be smart and look underneath the hood and go, nothing's changed. It's just always been volatility, stability, volatility to stability. It's this cycle, this constant cycle that Larry Williams talks about of large range bars are followed by small range bars. Small range bars are followed by large range bars. So that is just stability, instability, stability, instability, volatility. Hasn't changed. So your strategy has to be good enough to deal with that.
Finding the universal principles. I mean, it is just such a simple and profound concept. As we round out, Brent, I've got a few things I want to finish with today. A couple of things that are different and new. Just before we do that, just tell us about how much of all of this you share when you do your, you know, mentorship workshop thing. Like, what's the nature of that? Do you teach people a number of your strategies? How does that work?
Yeah. My whole idea about my website or education was I told you how I had that fight with that guru.
The forum, yeah.
I'd go off, I'd get licensed. I got licensed, and I published my real-time results. And so my whole thing's about transparency. I believe anyone can teach, but please, if you're going to teach, demonstrate that you actually trade what you teach.
Yeah,
And so I only make available what I personally trade. And so for my Universal Trader workshop, I'll be teaching 9 of my models. So I trade 20, and I'll be teaching basically 9 of those. If people go to my website, they'll see it's called Universal Trader Short Term, and within that umbrella, there's 3 models called Key Breakout, Key Swing, and Key Exhaustion. Within each of those models, they're made up, or they're comprised of internal patterns, and they generally have 3 patterns each. So I'm going to be basically teaching, half of what I trade.
And when's that next one coming up, and what's your website? And are you also, I don't think you're on LinkedIn and Twitter, are you? A bit of a quiet caveman?
I'm a caveman, more like a hobbit, but yeah, no, I don't. I'm not even on Facebook. I stick to my own thing. I just do my own thing. I don't advertise. I don't have a marketing gene in my body. I think if people are serious, they can search for stuff, and they'll come across the website. And and if they want to, I recommend people buy my books. There's a cheap way to get to listen to someone. And
we've mentioned the Universal Principles of Successful Trading, and the other one's more trend following focused. What's it called?
Yeah, Universal Tactics of Successful Trend Trading.
Yeah,
and there's a whole bunch of old strategies in there that it'll occupy people for 5 years just to go back and research it and code it all up, and they all work. Just pick which one you want. So my website's called indextrader.com.au. I got a workshop in late November. The first workshop is predominantly trend trading. There are mean reversion strategies within Universal Trader, particularly key exhaustion is basically a mean reversion strategy. And then the following week, I have just a 3-hour workshop where I teach a single mean reversion strategy that basically plugs in really well into Universal Trader. So that's all that information's on my website. And what I do too, which is different, is that not only do I teach models I personally trade, that for 3 months after the workshop, students get to watch me, their teacher, trade what he teaches, which is no big deal because this models I trade anyway. So
awesome.
It's a bit unusual in this education business.
Yes. No, that's great. I haven't asked about your tech stack because I know that it's pretty much you do stuff in VBA and you avoid the trade station and all the rest of it. So we won't go into that. It's usually something people like to hear. Now, what I want to do today, Brent, 2 things. One, I want to try something new on the pod that I want to steal from the Diary of a CEO podcast, which is a great YouTube pod. And he gets his guests to ask a question. I don't want you to tell me what it is now, but we'll write it down. We'll get a question for the next guest. So think about what that will be. And
I already know it.
Excellent. All right. We'll keep it secret. And then we'll finish the pod here. But what I want to do is roll into just an extended couple of minutes chat with you that we'll soon have a private members area. So we'll pop that in there. It's going to be a lot of stuff in there, not just this kind of thing, but I want to add a lot of value in there. So ciao to everyone else, and let's move into a couple of other strategy-specific things.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.